Hi, I'm Michael, and for this week's accounting class, I have chosen the adjusting process with looking at the accrual basis accounting and then the time period concept. When we look at accrual basis accounting, we can look at it with its effectiveness of importance. It records the effect of a transaction as it occurs, so therefore you get a more accurate, up-to-date account of a firm's assets rather than only recording cash transactions. And when you look at the short term, accrual basis accounting is more effective because if cash is not changed hands, then accounting will not occur for months, maybe even years at a time. So therefore it is a more accurate process of accounting. When we look at the time period concept in accounting, we can look at it through the explanation of it as it for accounting documents to be compiled for a distinct period of time, such as a week, month, year, or even a day. By using the concept of time, it allows the firm to choose a correct fiscal year for itself. If a firm is such as a retail business, it might consider ending its year at the end of January 31st instead of December 31st because it allows for more accurate recording of returns after the year has ended. The first look at a real-world application can be used for accrual basis accounting is that of a retail store manager. Say when the shift ends at the end of the night, there's $12,000 in daily profits, but $3,000 in returns. So therefore, you have a net profit of $9,000. If the manager neglects to remove the returns from profits, they are not accurately using a accrual accounting system to report their daily losses in consideration with profits. So therefore, the manager needs to be retrained to remove returns from profits to accurately record the daily business. The next real-world situation I can give also follows the retail outlet, but is at the general manager level and involves the use of time period concept. Say a store reports weekly profits, but at the same time also has to take into account weekly direct shipments of product from vendors. If the GM neglects to add weekly shipments of items from vendors, they do not take into account the cost of those items. So therefore the time period concept is not being followed because the new inventory is not going to be reported to a later date and therefore affect a different time period. If a GM wants to adhere to the basis of the time period concept in accrual accounting, the GM must make sure accurate reporting of all direct shipments is reported so they get a correct time period reporting of weekly profits that does not run into future weeks. The next use of the time period concept can be seen very well at the executive level of retail outlets. When the firm has to consider the executive level, its fiscal year, it must take into account that after the holiday purchases of December, there will be multiple returns into the month of January. When a firm looks for a fiscal calendar, it decides to choose to end its fiscal year at the end of January 31st versus December 31st, because if they chose the other date of December, they would be inaccurately reporting profits because the returns count as a loss, and by allowing for the losses to be accounted for in a fiscal year that ends on January 31st, they also are able to more accurately predict future returns the next year, so therefore they have a more accurate year because they account for all losses within a 12-month period that ends January 31st instead of December 31st. By giving their clients a more in-depth view of a 12-month cycle, they adhere to the time period concept by choosing their own end date for their fiscal year instead of a calendar year. When we look at the ethical implications of the time period concept, we can consider Matthew 13:39, which says, "The harvest is the end of the world." Well, if we consider our firm's profits as their harvest, we can consider that the end of the world will be the end of their fiscal year. If a company knows its cycle and chooses to end its fiscal year at the end of December 31st, and then notes large losses by returns into January of the next year, they are being susceptible to the enemy of the devil that has shown its face also in the same process. If a firm wants to be ethical, it needs to consider ending its fiscal year on January 31st, therefore giving its customers the time to return items that they do not want and removing the losses from their profits from the previous 11 months. When they do this, they are reaping the benefits of their harvest. Having a bountiful harvest can be accurately shown by considering the correct time period. Therefore, they show that the firm is more ethically inclined to choose its own end date of January 31st for the year and allow for the firm to show its real profits and not hide its losses in the next year.